Most traders don't lose because their strategy is bad. They lose because it's too complicated. You open your chart and add 3 indicators. They give you a signal, you take the trade, and you lose. So you remove one indicator and replace it with another. New setup, new signal, another loss. Then you change the entire strategy. Different indicators, different system, same result. Trade after trade, you keep searching for something new, when the real problem is complexity. Because sometimes the best trade comes from just one candle. Look at this single candle on the 1-hour chart. It has a clear high and a clear low. That gives you a complete price range. Now drop to the 5-minute time frame and watch what happens inside that same candle. Price breaks out of the range, then closes right back inside it. That is not a breakout. That is manipulation. This is where the entry forms. This is where the stop loss goes. And this is the target. Then price moves exactly where it was supposed to go. At first, this looks very simple, but don't be fooled, it's not easy. It's just much simpler than most of the strategies you've tried before. Stay with me, and you'll see how one single candle can lead to high probability setups and precise entries, trades that most traders only recognize after the move is already over. Now let's look at the opposite situation. This time, we have a bearish candle on the 1-hour chart. Again, it has a clear high and a clear low. That gives us the full range of that candle. Now drop to the 5-minute time frame and watch what happens inside that candle. Price moves below the low of the range. It looks like a breakout. Sellers start entering the market, expecting the move to continue lower, but then price closes back inside the range, forming a clear rejection candle. That's not strength. That's manipulation. The market just swept the stops below the low before moving in the real direction. This is where the buy entry forms. The stop loss goes just below the sweep, and the target sits near the opposite side of the range. Then price moves up and heads straight toward the target. This strategy may look simple, even a little stupid, but it works because the market usually moves in 3 steps. First, price goes sideways. That's accumulation. Then price breaks the range and traps traders. That's manipulation. And finally, the real move begins. That's distribution. Sideways. Trap. Real move. That's the market maker model. Now let's look at a real chart so you can see how this one candle concept works in live market conditions. We're on the 1-hour chart and this is our anchor candle. It has a clear high and a clear low. The moment you mark those 2 levels, you have your range. Simple and clean. Now watch what happens next. The following candle breaks below the low, but instead of continuing down, it closes back inside the range. That's a major clue. On the higher time frame, this tells you manipulation just happened. The market swept liquidity below the range before reversing. Now let's drop to a lower time frame and look inside that same candle. Inside this 1-hour move, you can clearly see the 3 phases of the market maker model. First, price moves sideways. That's accumulation. Smart money is building positions quietly. Then price spikes below the range. Stops get triggered. Breakout traders jump in. That's manipulation. So on the 1-hour chart, all you see is a simple rejection. But on the lower time frame, you can see the entire story hidden inside that single candle. Here's how the trade forms. Once price closes back inside the range, the manipulation is confirmed. That becomes your entry signal. Your stop loss goes just beyond the sweep, and your target sits near the opposite side of the range, where liquidity is waiting. And as price moves forward, it drives straight to the target. Clean setup, no confusion, no indicators, just pure price behavior following the market maker model. This is how one higher time frame candle becomes a complete roadmap. Once you learn to read it this way, you'll start seeing these setups again and again. What you've seen so far is only a small part of the strategy. In fact, it's barely 10% of the full method. If you stop here, you'll walk away with an incomplete setup. And incomplete strategies lead to impulsive decisions and unnecessary losses. So stay focused, because now we're going to look at the 2 core 1-candle setups that make this strategy work. The first setup is the foundation. You'll see it again and again across all markets and timeframes. Forex, crypto, indices, stocks, the logic stays the same. Candle 1, the anchor candle. This candle defines the range. Its high and low become your key levels. Once you mark it, everything that follows is traded around that range. Candle 2, the manipulation candle. This is where the trap forms. Price breaks above or below the anchor range, triggering stops and pulling breakout traders into the market. It often appears as a wick or rejection candle. Candle 3, the expansion move. After the liquidity sweep, price drives strongly in the opposite direction. That's the real move. But here's the key point. You don't chase the third candle. You position yourself right after the manipulation is confirmed. The second setup is built around the inside bar, and it fits perfectly with the one candle concept. First, you get a strong candle, then a smaller candle forms completely inside its range. That inside candle shows hesitation and hidden accumulation. You mark the high and low of the first candle. That becomes your range. Now watch the sequence. Price fakes a breakout. Liquidity gets swept. Then price snaps back inside the range. That snapback is your signal. And the move that follows is your opportunity. The breakout is the manipulation. The return inside the range is the confirmation. And the reversal is the trade. Now let's look at a real chart so you can see how this setup is traded step by step. We're on the British pound against the US dollar on the 15-minute time frame. First, we identify a strong candle. This becomes our anchor candle, the one that defines the range. We mark its high and we mark its low. These two levels are now our key reference points. The high acts as resistance, the low acts as support. Simple and clear. Now watch what price does next. Price breaks below the support, but instead of continuing lower, it closes back inside the range. That's a liquidity sweep. The market just grabbed stops below the low before reversing. Breakout sellers get trapped. Liquidity is collected. And once that happens, price often moves toward the opposite side of the range, where the next liquidity sits. Now let's drop to the 1-minute chart, which is our execution time frame, and look closely. The same thing happens again. Price breaks below the level, sweeps liquidity, and snaps right back inside the range. That's another sell-side liquidity sweep. When the same signal appears across multiple time frames, it acts as confirmation. The market is telling you that the liquidity below has been cleared, and the path upward is now open. Here's how the trade forms. The entry comes at the close of the 1-minute candle that returns inside the range. The stop loss goes just below the sweep, and the target sits at the 15-minute high, the high of the anchor candle. Now, before you get too excited about this setup, take a look at this chart. You might spot what looks like a perfect setup on the 15-minute chart. As you can see, the first candle defines the range, and the second candle creates the manipulation. Everything seems correct. So you drop down to the 1-minute chart, you place your entry, your stop loss, and your target. At first, the trade moves in your favor. It looks like everything is working, but then price suddenly reverses and starts moving straight against you. Then you try another one. As you can see on the 15-minute chart, the first candle represents accumulation, and the next candle creates the manipulation. Price closes back inside the range. Everything looks correct. So you switch down to the 1-minute time frame, you place your entry, your stop loss, and your target, and you wait. At first, the trade moves in your favor. It looks like it's working, but then price reverses and starts moving against you. If you want to understand why these trades failed and how to avoid these kinds of drawdowns, stay with me, because this next part can save your account. Let me make this simple with 2 quick examples. Let's say we're on the 15-minute chart. In the first example, you spot your anchor candle. You mark the high and the low. Then the next candle breaks above the high, but it closes back inside the range. Now, second example. Same process. You spot the anchor candle, mark the high and low. Then the next candle breaks below the low and closes back inside the range. Alright, quick question. Which one has the higher probability of working? The first one or the second one? I'll give you 5 seconds. Here's the answer. The first one has a much higher chance of working because the signal happens with the higher time frame direction. Price sweeps above the range, traps buyers, closes back inside, and that lines up with a bearish move on the 15-minute context. So when you drop to the 1-minute chart, you're not guessing. You already know you're executing in the direction of the trend. The second example has a much higher chance of failing because the signal forms against the higher time frame direction. It may look like a perfect sweep, but it's fighting the move that the 15-minute chart is already trying to deliver. Now take a look at this chart. Here the market is clearly trending upward. We spot a trade setup. This candle becomes our anchor candle, so we mark its high and its low. That gives us our accumulation range. The second candle is an inside bar. Then the next candle forms the trap. Price breaks below the low of the pattern, but closes right back inside the range. That's a fakey setup. And because it forms in the direction of the higher timeframe trend, it becomes a high probability trade. Now we switch down to the 1-minute chart to execute the entry. The entry comes at the close of the candle that returns inside the range. The stop loss goes just below the sweep, and the target sits at the high of the 15-minute anchor candle. Now watch what happens next. Price moves cleanly upward and reaches the target. Rule number 2, don't force trades. Patience is your edge. If the market doesn't give you a clean setup with a clear liquidity sweep, you simply skip the trade. Forcing trades usually leads to losses. The best setups are obvious when they appear. Now take a look at this chart example on the British pound, Japanese yen, using the 15-minute time frame. Here we have our 1-candle setup. First, we mark the support level and the resistance level to define the range. Then we wait. The next candle breaks above the resistance, but instead of continuing higher, it closes back inside the range. That's a clear buy-side liquidity sweep. The market just trapped breakout buyers, and now it's likely to move in the opposite direction. Now this is where the strategy really comes into play. One 15-minute candle contains 15 1-minute candles, so we drop down to the 1-minute time frame to refine the entry. On the 1-minute chart, price pushes above the same resistance again, then closes back below it. That confirms the sweep, and this candle becomes the entry trigger. The entry comes at the close of that 1-minute candle. The stop loss goes just above the high of the 15-minute candle, and the target sits at the next support level from the 15-minute chart. Now let's move to another real chart example, Solana against the US dollar. This time we're looking at Solana on the 15-minute time frame. And before we go further, remember this. The 1-candle strategy works across all markets: forex, crypto, stocks, indices, futures. The instruments may change, but the behavior of liquidity stays the same. Here we identify our anchor candle. We mark the high as resistance and the low as support. That gives us our trading range. Now we wait for the liquidity sweep. Look at what happens next. The following candle breaks below support, but then closes back inside the range. That's a clear sell-side liquidity sweep. It tells us the market just collected liquidity below the range, and price is now more likely to move upward. So we drop down to the 1-minute chart to execute the trade. On the 1-minute time frame, price breaks below the level again, then closes back inside the range. That confirms the sweep, and this candle becomes our entry trigger. The entry comes at the close of that 1-minute candle. The stop loss goes just below the sweep, and the target sits at the next 15-minute level. Now watch what happens next. Price moves cleanly toward the target, just as expected. That's the 1-candle strategy in action. Simple, precise, and based on real price behavior, not indicators or guesswork. Now let's move to the final rule, and this one can make the difference between a losing trader and a consistently profitable one. Rule number 3, always respect your risk to reward ratio. Take a look at these two setups. Both follow the rules. Both have a clean liquidity sweep. Both give you a valid entry. But the question is, which one is better, the one on the left or the one on the right? I'll give you a few seconds to think about it. The better trade is the one on the left. Why? Because it offers a higher reward compared to the risk. Even if both setups have the same probability of winning, the one with the better risk-to-reward ratio will make more money over time. This is where many traders get it wrong. They focus only on win rate, but win rate alone doesn't make you profitable. Imagine you win only 4 trades out of 10. That's a 40% win rate. Most traders would think that's bad, but if every winning trade makes 3 times what you risk, and every losing trade only costs you 1 unit of risk, you still end up profitable, because the size of your wins matters more than the number of wins. So instead of chasing a high win rate, focus on high-quality setups with strong risk to reward. That's how this strategy becomes profitable over the long run. If you found value in this video, make sure to like it, subscribe to the channel, and turn on the notification bell so you never miss the next strategy breakdown. Thank you for watching, and see you in the next video.